Now, one of the reasons that Confluent may have had such a worse CAC payback rate is because they've historically had pretty poor gross margins for a SaaS company, right? So they've done a good job dragging these up over the last 2 years. But early on here, so from Q3 of 21 through to Q1 of 23, they didn't have gross margins that exceeded 70%. And so what that means is when cost to serve is sucking up more than 30% of revenue, that means you've got less available cash to be able to spend on sales and marketing to be able to continue to drive revenue growth, right? Or to be able to reinvest in R&D. The best SaaS companies, again, just have much higher gross margins, right? Mondays are close to 90%, HubSpot sits around 85%. And so they just have much more cash available in the business to be able to reinvest in the product or reinvest in sales and marketing. So this has been, in my view, kind of a big drag on Confluent's business over the last few years. Now, despite that, it still surprises me a little bit that they sold for $31 per share, right? When they're trading at $38 per share earlier in the year. But basically what it tells us is that the leadership was kind of out of ideas. It's not an awesome result for shareholders, right? 35% premium is good, but when the deal is finalized, it's going to end up being somewhere around about 8.5 times ARR for a company that you would think is probably going to be strategically important in the age of AI, right? After all, that's why IBM's acquiring them. But that being said, right, we could see more of these in 2026 because the operating environment is just getting more challenging. The thing that SaaS companies live and die by is ARR growth rates. If you're not able to maintain a high rate of ARR growth, your valuation, your ARR multiple is going to be slashed. And we've just seen that time and time again. And so if you don't have a clear path towards how you're going to maintain high rates of growth, the best option may be that you get acquired for a premium. Otherwise, you may see those multiples continue to compress, and then you've just got a few years of slog to try to get out from under that, right? So we could see more of this, public SaaS companies with decelerating growth either get acquired by larger incumbents or taken private by private equity over 2026.